Seguimos a nossa Global Managers Conference e agora vamos falar sobre as oportunidades globais dos créditos corporativos. Os próximos painéis serão em inglês e temos fones para tradução simultânea localizados na lateral da plenária. Gostaria de convidar ao palco Brad Collins, CPM da gestora japonesa Nomura Asset Management, e Eduardo Arraes, sócio da BTG Pactual Asset Management, com moderação de Marcelo Santucci, sócio do BTG Pactual.
Okay, good morning, everyone. It's a pleasure to have you guys here. So I think it's a very important moment for us to discuss the credit and what's happening across the globe. I think it's more important than ever for us to recognize that how quickly the narrative has shifted worldwide. Just a few months ago, we were discussing the AI-driven growth story, balancing strong productivity expectations with concern of AI bubble. That was the narrative we saw end of 2025. But narrative has changed dramatically, I would say. Probably we are now in one of the most important oil shocks in modern history, with the disruptions in oil around 16 million barrels per day. If you look at other oil crises like 73, 2003, 1990, 2011, the disruption in oil flow was not more than 5 million barrels per day. So the shock today is asymmetrical. And the main concern is the inflation shock, not a growth shock. And that triggered a repricing in the yield curves. We saw dramatically change in the pricing, especially in UK, in Europe, Eurozone, and also in US, where markets were priced in cuts, and now currently it's flat or slightly a bias to hiking. So credit becomes more attractive, but also more complex. And it's not just a carry trade environment anymore. It's probably fundamentally a selection game. And on that environment, I think it's great to have Brad Collins from Nomura and Eduardo Arraes from BTG to talk about the risks and opportunities in this environment. So, Brad, I'm going to start with you. If we take this, sorry guys, if you take this environment, and when you monitor the global credit environment today, which are the main risks the investor should face? It's a financing risk, leverage levels, or even macro shocks.
Well, thank you all for joining. Look, but high yield balance sheet. So I work in a high yield business, so I think about credit in terms of more on the leverage finance size. And high yield balance sheets are in excellent shape right now. Liquidity is very strong. Less than 8% of the high yield market matures in the next 2 years, right? So we're not concerned about liquidity. We're not particularly concerned about solvency. Macro is really the key risks facing the market, right? And the market has been very focused on the quality of assets in private credit portfolios, been focused on the speed of AI disruption, and certainly been focused on Iran, right? So these, when you look at private credit, the challenge with private credit is the lack of transparency. Private credit managers don't mark their portfolios to market, so you're not really sure what's going on in those portfolios. But we have seen kind of a rush to liquidity where it's available. we've seen private credit managers take drastic markdowns on assets, marking it from 100 cents on the dollar to zero over the course of a month. That's raising concerns in the market that there's something going on in private credit. It doesn't directly impact high yield because most companies don't borrow in the public and in the private markets. But there's certainly indirect impacts in the sense of it impacts investors' overall risk appetite. And then there's some risk that if investors can't sell private credit, they might start to sell public credit. We haven't seen that, but it's a risk to monitor. On the AI side, with the progress that Anthropic has made in rolling out new AI tools, it's made the market ask the question of how fast is AI disruption coming? And to paraphrase Bill Gates, the market tends to overestimate short-term disruption and underestimate long-term disruption. So it's probably a little bit overdone in the short term, but the impact has been selling service companies that can be disrupted by AI, right? And it's given rise to a new acronym in the market, HALO, hard assets, low obsolescence, the types of companies that investors favor, right? So the firms that are most exposed are services firms and software, right? High yield is about 3% software. The broadly syndicated loan market is 14% software. Private credit is upwards of 20% software, right? So much more exposed than high yield. High yield also has a lot of legacy, old economy kind of companies, energy, packaging, chemicals, billions of dollars worth of assets on their balance sheet, right? Those are a lot more difficult to disrupt with AI. And then clearly Iran is the wild card. It's so far it's caused a sell-off in risk assets and a sell-off in rates. Right, so our expectation is that this is going to be resolved pretty quickly. Right, President Trump originally said 4 to 5 weeks. We're in week 5, so that's too optimistic. But Secretary Rubio was on the table over the weekend saying the military conflict will be settled in weeks, not months. That's our base case assumption. So I think the economy can stand higher oil prices for a short period of time without a significant impact on growth or inflation. But clearly there's a tail risk that the situation persists longer than we believe it will persist.
Perfect. Arraes, with this inflation shock, let's say, and like Brad said, the impact in oil has been at the front of the curve. If you look down the curve, it's more contained, as mainly when shocks happen. But how it translates into your market in the credit here in Brazil and overall, how it changed? What's the main risks you see today?
Sure. So I think the main risk that I see for the local market, right, the market that I spend most of my time, it is, I would say the main topic would be the interest rate. This is, as you know, right, we have been living in a country with very high interest rate for some time. And there was this expectation that probably during this year we would see a relevant decrease of interest rates. And most of the companies were counting with that, And since the start of the Iranian war, as you said, oil prices went up, and then we're seeing an impact in the inflation expectation across the globe, and we're seeing also impact in the interest rate curve of developed countries, but also in Brazil. And why this is so important in Brazil, right? I would say that usually, although it's a bit counterintuitive, but usually when interest rate goes up in Brazil, this is good for the credit market, right? Because it's a floating rate market in which when the rates get higher, then usually equity doesn't perform that well, but it doesn't impact the credit market. And we see a lot of flows to the credit market as it happened in the last years. And spreads tend to get tighter because of the flows. But this time specifically, it was even different than that. We're seeing, as I think most of the market was expecting, most of the companies were expecting to see this decrease of the interest rate. Now that it is out of the curve of the market, we're starting to see investors become a bit more cautious about credit risk. If you go back 2 years ago, even 3 years ago, right, the local credit market has developed a lot. We saw companies being able to raise bigger size in the local market, longer tenors, and increasing a lot the liquidity. But over the last quarters, almost, I wouldn't say all of them, but almost all the companies that we analyze are having problems to pay the interest with this high CDI. And it was okay because liquidity was very high and the companies didn't have that much maturity over the short term. But I think all of the CFOs were expecting, to see that rates would go down quickly this year, and investors as well. Now that this is not happening, I think this is the main topic for us to follow. I would say if you talk about leverage, we see some companies getting more leverage over the last years. But again, I think it's okay if rates go down, right? If the rates go down in the next 12 or 18 months. If it stays like it is today, or if it decreases just a little bit, I think we're going to see more companies going into restructuring. Some people ask me about refinancing risks as well, and again, I don't think it's that relevant yet. It is starting to get relevant. We're starting to see in the secondary market, again, some investors getting a bit more concerned about the market, selling some names at very high rates and very high spreads. So if you have a very good company, but it is trading at CDI plus 6, CDI plus 7, CDI plus 10 at some point, then although those companies usually have a lot of cash, have time to refinance, but if they are burning cash because the rates are high and they are not being able to roll their debt because the secondary market is CDI plus 10 and they don't want to raise new debt at that level, so that might be a problem over the next 12 months. So to me, the main topic to follow, that's where I'm spending most of my time, is the interest rate.
Well, excellent. And another question related to this, it's how unpredictable is this environment because of the geopolitical risk? We mentioned that inflation, there's a pass-through to, oil crisis has a pass-through to inflation. And so far, the inflation, it's more, maybe it could be could be an environment where 3% could be a new normal, let's put it this way. That's why central bank, at least the market is anticipating hikes, not necessarily going to happen. But I think the length or the duration of this crisis will dictate the macro environment. So, Brett, again, how do you navigate this unpredictable environment, the geopolitical risks, to manage the portfolios?
So I'd say a lot of the geopolitical risk that we've seen has been triggered by the Trump administration, right? And just putting things in context, Trump is a second-term president. So when he and his team took office last year, they viewed the situation as they have 4 years to rewrite the rules of the global order to provide more benefit to the US. So they're sprinting to do that. Right. So a lot of Trump's actions look to be unpredictable, but if you understand how he operates, his actions are more predictable, right? So we all know that Trump is a showman. He's full of bluster, right? He loves to prove himself right. He wants to strike a great deal, and that's the way he operates. And I'm going to repeat something I shared at this conference last year, but if any of you have ever taken a class in negotiations, one of the first things you learn is the concept of anchoring. Right? You want to anchor the negotiation on an outcome that's favorable for your side, and then offer concessions to reach an agreement. Right? Most U.S. politicians are afraid to do that. They're afraid of being accused of flip-flopping, and flip-flopping ruined the careers of politicians like Mitt Romney and John Kerry. Right? Trump doesn't care. He's the master of the deal. Right? And so he says outrageous things to start the negotiation, then he offers concessions to reach an agreement. And then, the other thing to keep in mind is George Friedman is a political analyst who I have a lot of respect for. He founded Stratfor, more recently he founded Geopolitical Futures. And he said, if you want to forecast the actions of a politician, don't listen to what they say, don't study what they want to do, analyze what their constraints will allow them to do. And the biggest constraint facing President Trump right now is midterm elections in November. Right now, the Republicans control both the House and the Senate. If they lose either chamber of Congress, then Trump's final 2 years as president are going to be disrupted. Right? The Democrats are going to use that House to block any legislation. They're going to investigate him for a variety of transgressions. He's likely to be impeached for something, right? So his last 2 years will be sidelined. So the key theme in American politics right now is affordability, right? The idea that over the last few years, Americans' wages have increased, but prices have increased faster, so they feel less wealthy. So when you look at the two key issues of the last 2 years, tariffs and Iran, those certainly do not help affordability. Right? So Trump is going to want to get back on track to showing growth, showing wages rising faster than inflation between now and November. Right? So when you look at tariffs, he'll say something outrageous. We're going to slap 100% tariff on China. That's the start of the negotiation. He's going to offer concessions to get something in return to reach an agreement. And when you look at the actual effective tariff rate based on revenue collections, the tariff rate's about 10%. It's not 25, it's not 50, it's not 100. So similarly, when you look at Iran, the U.S. can withstand $100 oil for a short period of time, but if in October gas costs $5 a gallon, the Republicans are going to lose, right? So I think the Trump administration is going to move quickly to get the best deal they can in Iran, declare victory, and move on.
Excellent. There's a hurry to get this settled down, right? There's an interest to get that. Prices, political interest, like affordability, great points in U.S. As you mentioned already, the need for the interest rates to be in a lower levels, and it seemed the central bank was ready to start cutting, and then need to postpone a little bit. Now it's cutting in 25 basis points clips, but this geopolitical situation and energy shock, how do you see this new environment, which is unpredictable looking forward? How has changed the way you look at the portfolios?
Sure. So look, in the second half of last year, we were a bit uncomfortable with the level of the spreads in the local market. And we reduced a lot the risk in our portfolios. We reduced the duration of credit portfolio, increased the cash. And we were waiting for a moment in which those spreads would reprice. Of course, we had no clue about the Iranian war, but in a way, I think it's a good moment for us for that to happen, because we have, again, a lot of cash. We're starting to see some redemptions in the market as a whole, but still like small levels. Even if that increase, I think that's not going to impact us, and I think we're going to be performing much better than our relevant peers, because we're taking less risk. So my point is that we have the benefit of being able to pause and analyze a little bit the market. We don't need to sell assets to pay potential redemptions. We can wait a little bit to see what's going to happen in the market. My business, so the local business, is a business that you don't have that much liquidity, so usually you are not trading what is happening this week or next week. You have more of a medium-term perspective. So I think if you ask me what we have been doing, is that we are only investing in new cases that we really think that are good. So I think, again, different for most of my peers that probably are not allocating now because they don't know if they're going to receive redemptions requests or not. I think as we have a lot of cash, we are starting to allocate in some assets, but cautiously. And I do think that one thing changed, which is that we're not comfortable with that scenario that the rates are going to go down as quick as before, right? So I think it's not the time, to invest in holding companies that are very leveraged. I think it's, as I said, we start allocating a few names, some very good names that we know that are not going to have a problem, but that we're seeing spreads getting a little bit wider than we saw a few months ago.
Excellent. Now the next one is to Brett. When we look at the behavior of especially in March 2026, this current month, the price action in the interest rates and in equities, which we saw high interest rates in the futures market and lower equity prices. It seems there are some similarities with 2022 when we saw these both asset classes performing in a negative territory. But at that moment, the concern, I think one of them was about the recession risk. But when you look now, 2026, we start the year with, at least in US, with a growth momentum. Still, we have prediction between 2.5%, was 2.7%, but overall the median of the street is still around 2.5% positive GDP. With that, and clients always ask, well, with this correction, it's the right moment to invest in high yield. It's an opportunity, it's a risk. It's something that we're missing. How do you put this timing in terms of opportunity in the high yield class as a part of the portfolio of the investors?
Yeah, we think this is an excellent entry point for high yield, right? And again, our base case assumption is that the situation in Iran is going to be resolved sooner than later, right? So that's clearly a tail risk. If that persists, then our view and the outlook will change. But we think 2026 is going to be a strong growth year for the U.S. If you look back to 2023, 2024, the U.S. grew close to 3%. Last year, that growth rate slowed to closer to 2%. This year, we expect growth to be back around 3%. And that's that's a very favorable environment for high yield, right? We think that there's a number of factors that are going to drive stronger growth this year. First and foremost, it's an election year, right? So fiscal policy in the U.S. is going to be even looser than it's been in recent years. Secondly, the Trump administration has locked in lower interest rates, takes a lighter touch approach to regulation, which is favorable for growth. The Fed's in easing mode. Right now, the Fed funds futures are pricing in no action this year. Last week, there was pricing in a small risk of an increase. But we think once Iran is out of the way, then the Fed's going to be back in easing mode. Nomura sell-side economists think that 2 more cuts this year. Right? So that's stimulative for growth. And we also believe that AI is going to start to pay off in terms of higher margins for AI users. So all these factors we think are going to drive stronger growth in 2026. Again, favorable environment for high yield. Default rate has been low. It's about 1% over the last 12 months, 2% if you include distressed exchanges. We think that growth rate is going to allow the default rates in high yield to remain low, but at the same time, growth will likely be slow enough to allow the Fed to ease incrementally. Right? Favorable environment for high yield, likely see continued low default rates, and then that carry the asset class at around 7.5%, very attractive at a low default rate. Now, when you look at spreads in January, in the middle of January, we're at 265. The all-time tight is 240. So we're getting down near the all-time tight. Spreads have widened back to about 350, right? So a more interesting entry point, still at the low end of the range. When you look over history, spreads can remain at the low end of the range for an extended period of time. There needs to be a catalyst that causes spreads to widen. It can be a black swan. The Iran situation spirals out of control. That's a risk. But it's usually a recession. And when we look at the U.S. economy, we just don't see a recession on the horizon. There are too many pockets of growth. If you look at investments in AI and technology, investments in energy, investments in electrification, there are too many pockets of growth to envision a recession. So we think spreads can remain relatively tight, possibly tight. It's tightened a bit from where they are today, and investors will enjoy the very strong carry from the high yield asset class.
Yeah, just to repeat the number, you mean the yield to worst of the portfolios in high yield is above 7%, right?
Yeah, it's more than 7.5% right now.
This is very important information. And we were looking at, we tried to do an exercise ex post, which would be if we knew that the war, this U.S.-Israel conflict would happen, and one could thought, well, let's buy gold, and gold did not perform well in March. If you thought that, well, I'm gonna sell the markets, buy dollars, and with the dollars buy the risk-free or U.S. treasuries, right? And one line of defense, if you buy a 10-year bond in U.S., if you take the mark-to-market year-to-date, March or even year-to-date, the performance of this portfolio with solely in the 10-year treasuries, the mark-to-market would be negative 1.5%. If you had invested the same amount of money and in high yield in the index, let's put it this way, in the index, you would have also slightly less than 1.5% down. So it's counterintuitive that, well, high yield, it's more risky. Yes, it's more risky in terms of credit, but in this inflation shock, because it's an inflationary oil, energy, inflationary shock, it changed the curves, yield curves. So the duration played a more important role in damaging the mark-to-market of the assets than the credit spreads. So because the duration of high yield is shorter than a global aggregate index, for instance, protects is better than the sovereign. And again, right now, with the yields above 7.5%, it's a very appealing, and with shorter duration and with the quality of the market, especially in US versus other regions, it's very appealing to explore, to have this asset class exploring the portfolio. So we agree with most of the Nomura view on the activity and the inflation. So Arraes, in Brazil, this environment of higher than previous expectations in terms of interest rates, or at least the speed of the easing cycle, is there sectors that is more idiosyncratic, more exposed or to stress than others? How to navigate this in terms of exposure? How to select the companies or sectors? What are the opportunities right now?
Okay, so yes, there are sectors that are more impacted. I would say, of course, real estate and retail sectors are one of the sectors that are more intensive in capital. They need to finance themselves at transactions that usually are indexed to CDI, so they are the first two sectors that are the most impacted. But I would say that this time we are starting to see companies getting a bit more leverage and facing restructurings in other sectors as well. If you look at the previous crisis, I would say those two sectors were the most impacted. But if you see this time, last year, for example, the agro sector was very much impacted with a few companies going through restructuring. More recently, you are seeing impacts in the health sector as well, with companies not performing very well. We saw petrochemical companies as well suffering in Brazil. Of course, it's like a global issue that companies outside Brazil are suffering with petrochemical spreads. But if you're financing yourself with a CDI at 15%, then the problem is even bigger. So it's time to be a bit more cautious. I think us as portfolio managers of a fixed income strategy, that most of the investors are very conservative. They don't want to see volatility. Our job is to try to still generate a good return, but be aware of all of those cases that I mentioned, right? And it's been difficult. I think so far we have been very successful. We saw a few restructurings happening this year, and we are out of all of them. But I think in times of this, it's what we try to do is to have a very diversified portfolio. And also, I still don't think it's time to invest in risk names. I think that's where if you need to increase your carry, because most of last year, for example, we're having this discussion with some investors saying, look, let's increase a bit the carry of the portfolios. What can we do? And if you're going to increase the carry, you're going to increase the risk, right? And I think currently is still not the best time to do that. But I do think that over the next months and probably in the second half of the year, we're going to be able to invest in sectors, I would say probably infrastructure sectors. That's where we still see a good number of issuances, a good number of options to allocate money. There is also here in Brazil the infrastructure tax exempted market that I think there is good. It offers good opportunities of allocation for individuals as well. So I do think that over the second half of the year, we're gonna see a better entry point. And until there, what we have been trying to do is to keep a portfolio with lower than average allocation, higher liquidity, shorter duration, so that we are prepared to do this, to take those opportunities that are starting to arise in the market.
Excellent. And when I mentioned at the beginning that the oil disruption, this current crisis around 16 million barrels per day, also it translates to how this impacts overall markets, but regions. if you take the ratio oil-gas dependence as a percentage of GDP, Brazil and US are net exporters. But if you take Europe, Japan, and parts of Asia, they are importers. So then you infer that the fragility or the vulnerability of other regions versus US are bigger. So with that in context, Brett, how do you see the global opportunities or the sectors? How do you find opportunities within different regions to explore the high yield in your portfolios? For credit, corporate credit, right?
Yeah, so look, we're kind of agnostic between US and Europe right now in our portfolios. We have a small overweight to the US versus Europe. Europe has been trading cheap relative to the US on a spread basis in the post-financial crisis environment. But more recently, the spreads are pretty similar in the two markets, and we think that Europe is more exposed. As you say, Europe's a net importer of energy, and they haven't really resolved their long-term energy security challenges. I mean, it's a much less dynamic economy. It's overregulated. It's difficult to generate growth. That's chasing companies away from Europe to other markets. So we think Europe should be trading at a premium to the US on a spread basis, and it's not. Europe has been more interesting on a hedged yield basis because of the hedging costs, but we've seen hedging costs come down a little bit, the differential between US and Europe. So yields are pretty similar in the US and Europe, and we think Europe should be trading at a premium. And then when we look at high yield versus other credit asset classes, we think high yield looks really interesting. You look at high yield versus loans, right? So the Fed's been easing the last couple of years. That's reduced the amount of income that loans generate. And we expect the Fed to get back into easing mode as 2026 progresses. Again, reducing the coupon of floating rate instruments makes high yield look a bit more interesting. But from a credit quality perspective, high yield looks a lot stronger than loans, right? There's been a tremendous demand for CLOs the last couple of years, and that's caused a slippage in underwriting standards in loans. So the default rate of high yield, including distressed exchanges over the last 12 months, is about 2%, is more than 3% in loans. When you look at upgrade versus downgrade activity, over the last 12 months, high yield has seen more upgrades than downgrades. The opposite's true in loans, more downgrades than upgrades. And when you look at the overall credit quality of the market, high yield is 59% double B, and it's 9% triple C. Loans are 23% double B and 11% triple C and non-rated, right? So the low quality cohort is about the same in the two markets, but high yield's a double B market. It's almost 60% double B, whereas loans are very much a single B market. That's what CLOs want. Loans are 66% single B, right? So we think going forward, the default probability looks a lot stronger in high yield than it does in loans. And then when you look at high yield versus investment grade, right, if you think the economy is going to collapse and rates are coming down, then you should buy investment grade. It has twice the duration, much less spread risk. But spreads are tight in high yield, relatively tight in high yield. They're tight in investment grade, inside of 100 basis points. There's just nowhere to go in terms of spread tightening in investment grade. And we think that, we think carry is what makes credit interesting in the current environment. The yield that credit offers is what makes the asset class interesting to investors. High yield is yielding more than 7.5%. Investment grade is yielding 5.2%, right? So if you're looking at investing in credit because of the carry, then you're much better off in high yield than investment grade.
And Brett, we are seeing some stress in the private markets, right? Private lending. Do you think this can translate into public markets in terms of liquidity or even spread widening? How do you read this? We've seen some news about redemptions in the private markets, probably because the lenders or the managers went into the retail pocket to finance the industries that needed higher capex, like software, etc. But it's something that worries you?
Yeah, I mean, I think private credit in many cases has been missold over the last few years. And, my team has business around the world, in Asia, Europe, Middle East, Latin America, the U.S., Canada, right? And 2 years ago, when I was traveling around meeting with a lot of more wealth management-oriented clients, there was a strong preference for private credit. There was why would I invest in public credit for the same risk when I can get more yield in private credit? And then there are these kind of semi-liquid structures that allow 5% redemptions every quarter. So like, well, I can get out when I want to get out. I've got more yield. Why would I buy high yield? And then I've gone back in the last year, and it hasn't been a disaster, but the returns have been high single digits, which is what high yield has done over the last couple of years with no liquidity in private credit, right? So there was there wasn't necessarily it didn't live up to their expectations, but it wasn't a disaster. But now we're seeing a lot more concern because we're not really sure about the credit quality of what's actually in those private credit portfolios because they don't mark to market. Right, so one area that we can see is in the percentage of private credit portfolios that are paying interest in kind. And there's a lot of different calculations on that. I've seen some that suggest 4% is paying in kind and others that suggest double digit of private credit is paying in kind, right? But we do know that there are more companies in private credit portfolios that are under stress. And when you look at the high yield market, there's been very little issuance in CCCs over the last couple of years because those CCC companies have been borrowing in the private credit market. They haven't been borrowing in the public market, right? So those lower credit quality companies that are more likely to have credit problems aren't sitting in high yield portfolios, they're sitting in private credit portfolios. So I would expect to see more default activity. We're likely to see more markdowns of prices, continued demand for liquidity when it's available. And, that's it. It's the biggest impact on high yield. Again, it's not the direct impact, it's the indirect impact. It's the confidence in investors having credit more broadly. And then if investors want to reduce their credit exposure, they can't sell private credit. So there's a risk that they start to sell public assets where they can get a market. When you need liquidity, you don't sell what you want to sell, you sell what you can sell. Right? So that's a risk. We haven't seen it yet. We haven't seen a lot of flows out of high yield because people want to reduce exposure to credit, but that's certainly a risk that we're monitoring.
Excellent. And Arraes, you mentioned the high interest rates, CDI, but also when you look at when you build portfolios with corporate credit, actually, when you build portfolios of credit, you can invest in sovereign bonds, and investment grade bonds, high yield bonds, distress. And here today in Brazil, I think you have a challenge of competing, or have the option actually, to invest in sovereign bonds, linkers, the NTNBs, yielding around between 7 to almost 8% real interest rates. So how you balance these? How investors should look at the portfolio managed by your team? How do you balance these? Where you see the opportunities, and how to differentiate from the sovereign that is yielding that much?
Okay. So just to explain one point, and I think it's interesting here, is that when I say that the market that I'm involved here locally is mostly investment grade market, it's investment grade in the local market, right? But
Perfect.
Actually it is mostly a high yield market so most of the comps that I invest, for example, would be a high yield globally speaking, at least in the bond market. So most of the problems that you mentioned, I think affect our market as well. If the only few names that are investment grade globally in Brazil, those are companies that, when we analyze the transaction they issue in the local market, they usually are transactions with very long tenor, very small spreads, very low spreads, and they don't have the benefit of the interest rate curve decreasing when, as you said, there is in the US, right? Because here's a floating rate market. So the only component of risk is the size of the spread. Also, our market, different from the high yield bonds, this is a market that we cannot short, right? The whole market is only long, even if it's a high yield, investment grade, everything. So in the end, it becomes very dependent on the technical environment and what the retail market is doing, right? If you're seeing a lot of inflows in the market will get tighter, and there's not much what you can do. So when I look the last 12 months, what we tried to do was to not invest that much on the clear AAAs, right? On the best companies that are AAAs, because those companies would be issuing 10-year transactions with very low spreads. But also, we didn't want to go to non-rated or high-yield bonds too much as well, because we thought that on the environment that we were at, our impression was that spreads everywhere were a bit lower than what it should be in the local market. But if you're talking about a AA, then it's a little bit lower than what we think it should be. But if it's a non-rated bond or very high yield in the local market, sometimes companies that were issuing 2 years ago at CDI plus 7 was issuing at CDI plus 2 without too much change in their balance sheet. So we try to be in the middle of that, trying to allocate mostly in single A's and double A's. I would say mostly in double A's and a little bit in A's. And we increased a lot our exposure to financials because they are usually very short tenor, so they help. Of course, the carry is way lower than corporate bonds locally, but at least there is some carry there. If you look at the past, our main strategy, which is the credit corp strategy, is to have, let's say, 10%, I would say, 10 to 20 in financial bonds. Currently, we have around 40% in financial bonds, so it became much more relevant. In terms of government bonds, the problem is that I totally agree with you that the level is very high, and I don't think that's going to be like that for a long time. But the problem that we have is that our market's mostly a market that's indexed to CDI. So investors want the returns to the funds to return over the CDI basically almost every day, right? But at least every month. And we saw that the NTNB has a lot of volatility, so most of our products, we cannot take the market risk of the NTNB. So I would say that most of our products, we don't take this risk. What we have been doing, for example, is that, for example, in the infrastructure market, this is a market that grew a lot, also in the fund that's indexed to, that CDI is the benchmark, but the assets are indexed to inflation. So actually the whole market, we hedge the inflation component. What we have been doing over the last months is that we're not doing 100% of the hedge. We're doing 80% or 70% of the hedge because we do think that NTNB is at a very high level, and at some point this is going to get tighter, and this will help the funds to perform well.
You're going to take the opportunity to see the sovereign collapsing the yields and then be reflected in the corporate spreads and to follow through, right?
Exactly.
Perfect. Well, it's been very intense and interesting discussions. For final takeaways, Brad, which message you would like to share with the investors regarding the global backdrop and the opportunities in the high yield space and other comments, especially all that we discussed this challenge or a year that we just started?
Yeah, so as Brazilian investors, if you're looking at local nominal rates at the low teens or real rates at 7-8% range, right? It's really tempting to just invest locally and not worry about international diversification. But we live in a very uncertain world, right? With the geopolitics, you've got an election coming up here in Brazil later this year. We have another election in the U.S. in November. You have differentials in monetary policy with the Brazilian central bank starting to ease. U.S. maybe on hold, maybe raising, maybe reducing rates at the Fed, right? So it creates a lot of uncertainty, and in that kind of environment, nominal returns can be ephemeral if inflation picks up in Brazil, or if the currency sells off relative to other currencies. You may wish you had more international diversification. So look, in an uncertain world, your best defense is diversification, right? And that's diversification by local and international investing, diversification across asset classes, equity, fixed income, commodities, public versus private markets, fixed versus floating assets, investment grade versus high yield. The more diversification you have in the portfolio, the more likely you are to have a positive outcome in your overall portfolio results.
Arraes, time to invest, be cautious, to select quality. So your message to our clients, investors.
Yeah. So look, I think the main takeaway from me is that this is an asset class as any other one. So we have cycles. Sometimes the spread is going to be tighter. Sometimes it's going to be wider. If you look at the last years, it's been a long time that we don't see a year in which we saw a relevant widening in spreads. I think this last time was 2020. 2023, we saw a little bit, but quickly the market reacted. I think this time is going to be the same. It's going to be more similar to 2023. You know, when 2020 it was different because we saw a big risk aversion and also interest rates become very low. So there was not that interest from investors. I think this time we probably needed some spread widening after a few years that the market was performing really well. I think this first half of the year, the market will digest a little bit those restructures, some of my peers not performing that well. But I do think that this is going to create opportunities for managers that are doing a good job, that try to trade a little bit the cycle, that were not impacted by those cases that I mentioned. So I think that if you are in a good fund and well managed, I think this is going to be maybe for a few months the strategy is not going to perform as performed historically and perform a little bit lower than CDI as we saw in February and March. But I think over the year, I still think there's going to be a lot of opportunities and the strategy going to perform well another year.
Excellent. Thank you for the insightful thoughts, and thank you, the audience, for the presence, and thank you again.
Thank you.
Muito obrigada, Santucci, Arraes e Brett.